If you really track the drivers of global growth today, I mean, the companies leading in AI and biotech, you realize something pretty fundamental. We aren't just in a new phase. We're using an accounting rule book that was designed for a world that, well, that basically ceased to exist 50 years ago.
That is the core tension, absolutely. It's often called the quiet revolution. You see it mapped out in books like Capitalism Without Capital.
Right.
For the first time, really in economic history, global investment in intangible assets, so software, data, branding, R&D.
All the invisible stuff.
All the invisible stuff. It has decisively eclipsed investment in tangible assets, factories, machinery, buildings. We are now in an economy of bits over atoms.
And this leads to this fundamental frustration that you, the listener, probably feel. We all see the shift happening, but when you go to dive into a financial statement, we lack a cohesive physics for what these assets even are.
We do.
How do you quantify the potential energy that's stored in a proprietary algorithm? What is the base unit of a brand? The old equations just don't work.
They don't. Our standard financial language, it just fails. It fails to capture the real source of modern competitive advantage. And the source material we're digging into today suggests this profoundly counterintuitive answer.
Which is?
That the philosophical framework we need to fill that gap comes from revisiting Karl Marx's labor theory of value, specifically this idea of congealed labor.
Okay, I can already hear some flags going up. Hearing Marx applied to investing might sound a little strange.
Of course.
But let's follow the source material's directive here. This is not about adopting a political ideology. It's not a magical valuation shortcut.
No, it's about mechanical thinking, purely mechanical.
We're setting aside all the political baggage to just borrow a powerful, internally consistent lens for dissecting modern businesses that are driven by human effort.
We're just trying to find the underlying architecture of value. What is an AI model or a new drug actually built out of?
Okay, so let's unpack this. The best place to start is the most obvious breakdown in the system: the current accounting failure. Our rulebook, GAAP, treats the money spent creating lasting intellectual property, say R&D or software development. It treats it as an operating expense.
It's a cost that's just immediately consumed, gone. If a company spends $1 billion developing a brand new AI engine that's going to be productive for a decade.
A huge, lasting asset.
It's a huge asset. GAAP treats that cost in the exact same way it treats the month's water bill or the cost of printer paper.
So this monumental creative expenditure just disappears instantly into the P&L statement. It leaves no record on the balance sheet.
The cost vanishes, but the capability, the asset, it doesn't. And this is where Marx's framework from Das Kapital gives us a kind of definitional rescue. He drew this critical line between living labor and dead labor.
Okay.
Living labor is the current active human effort, the hands-on work, the coding, the brainstorming, what people are doing now.
And dead labor.
Dead labor is capital itself, the machinery, the tools. But Marx's insight was that dead labor is simply living labor that's been stored.
So it's not just a machine, it's a time capsule.
Exactly. A physical machine, like a factory stamper, is the physical result of hundreds of hours of human effort. The designers, the miners who got the steel, the builders who assembled it.
All that human effort is congealed or frozen inside the machine.
Yes. Waiting to be released slowly over time through wear and tear, which we call depreciation. That dead labor then transfers its value into whatever the machine makes.
So if a traditional asset is frozen human effort in steel and concrete,
Right.
then a modern intangible asset has to be what? Frozen human effort in code and data?
That is the conceptual leap. Think about that software company again. They pay a team of engineers $50 million in wages to build a critical piece of software.
Okay.
That $50 million, it's not just an outflow, it's a conversion. It's a conversion of currency into capacity. The living labor of those engineers, the debugging, the design, all that intense effort, it gets congealed into the digital asset.
And that code base becomes the dead labor. It's the machine that will keep working long after the engineers have moved on.
Exactly, performing continuous high-leverage work. And the value transfer happens not through physical decay, but through amortization, that slow release of stored human value.
I think this distinction is so crucial, and it links right back to the accounting controversy.
It really does. Because when investors try to adjust financials to capitalize R&D, to treat those wages as an asset, the critics immediately cry foul.
Saying we're speculating.
Right, that we're recklessly guessing at the asset's future market value.
But the source material makes this powerful counterargument, drawing on thinkers like Rob Breyer. It suggests capitalizing R&D is actually the conservative approach.
That's the punchline, isn't it? We are absolutely not speculating on future cash flows. We are simply recording the asset at its historical cost.
We know what was paid.
We know $50 million in wages was paid.
Wow.
We know that payment was transformed into a durable, productive capacity. The whole point of the balance sheet is to record past efforts that yield future benefits.
So refusing to capitalize that effort is basically denying that the past work has any future value at all. You're denying the seed was even planted.
Exactly. You are simply ensuring the balance sheet tells the truth about the cost of building the machine, even if that machine happens to be invisible.
If the machine cost $50 million to build, the balance sheet should show $50 million.
Right. The income statement can worry about what it eventually earns.
Which is a perfect transition. Let's talk about the income statement and the question of return. How do we measure the return on that congealed human effort? The source uses the value stick concept.
The value stick is really elegant here. You have willingness to sell, or WTS, which is basically the wage paid to the worker. It's the minimum they'll accept for their time.
And on the other end,
Willingness to pay, WTP. That's the total value the customer gets from the final product. The spread between them is the profit, or what Marx called surplus value.
in the old 19th century economy, that spread was really constrained. If a factory owner wanted to double their output, they generally had to double their input.
More iron, more steam, more labor. You had to nearly double the input to double the output. The leverage on that human effort was capped.
It was linear. That machine, that dead labor, could only stamp so many parts per hour. But the intangible economy just, it throws that linearity out the window. This is the intangible twist.
The leverage is, well, theoretically infinite. The software engineer gets paid a fixed linear cost, let's say $200,000 for the year. That expense is the same whether their code is deployed to 10 users.
Or 10 billion users.
Or 10 billion users worldwide.
Yeah.
The marginal cost of replication is basically zero.
So the input cost of the living labor, the wage, is fixed. But the output value for the customer can scale exponentially. The gap between input cost and output value is potentially boundless.
And this gives us a fantastic, really deep interpretation of return on invested capital, ROIC.
Okay, how so?
If we correctly capitalize R&D, if we build the denominator of the ROIC equation out of the wages paid to build the machine, then a structurally high ROIC isn't just a sign of efficiency.
It's a measurement of...
It's a precise measurement of labor leverage.
It's proof that the company has successfully decoupled the cost of labor from the value of labor. They're paying for inputs linearly, but capturing outputs exponentially.
The higher the ROIC in one of these firms, the more effectively that congealed human effort has been weaponized and deployed.
But wait, if the potential profit is that huge, why are we even talking about a $200,000 wage? Why doesn't the engineer just leave, start their own company, and demand the full, near-infinite value their code creates?
Ah, that's the friction. And it's all rooted in risk. The differences between what the source calls deterministic capital and probabilistic capital.
Explain that.
Tangible capital is deterministic. You pay to build a factory. It's going to stamp metal. The risk is pretty low. You know it will perform its function.
But investing $50 million in R&D for a new drug trial or some frontier AI project, that is totally different.
It's probabilistic. It's like buying a high-leverage call option. The project might fail completely. You'd have real dead labor, $50 million in wages paid, but the realizable value is zero. You bought a machine that does nothing.
So the knowledge worker isn't accepting a low wage relative to the potential outcome. They're accepting a guaranteed wage relative to the probabilistic outcome.
Precisely. The corporation acts as the insurer of labor. It takes on all the risk of failure and pays the scientist a guaranteed wage no matter what.
And in exchange for that insurance.
In exchange, the firm buys that massive call option on the near infinite value if the project hits. The firm is paying the insurance premium to get the upside.
And this framework also gives us a clear meaning for failure, which is, just part of the game in these businesses.
It is. When a drug trial fails, that capital option just expires worthless. And that's when amortization and impairment step in. It's the balance sheet's way of learning.
The uncertainty resolves unfavorably, and the stored labor gets flushed out as a loss.
The expenditure was real, but the asset capacity is gone. Though it's important to note, the source is clear. Accounting capitalizes productive capacity, not wisdom.
Right. A failed trial might teach you what not to do, but the balance sheet has to write off the specific path that failed.
Which means failure isn't an anomaly. It's the calculated price you pay for operating in regions of the highest possible leverage. So you get the spectrum of predictability.
On one end, you have deterministic assets like
Mhm.
factories, smooth depreciation.
Then you have frontier assets, like drug discovery. They're binary. Most of the time, the dead labor expires worthless.
But the few that succeed scale without bounds, and that justifies the entire high-failure strategy. It brings us to the last piece of the puzzle, compensation.
Right, the paradox of modern compensation.
So what does this all mean for stock-based compensation, SBC? Most investors, I think, see it as an annoyance. It's dilution, it's a non-cash expense, it's just noise. How does this lens reframe that?
It reinterprets SBC as a crucial mechanism of co-optation.
Co-optation.
Think about the core vulnerability of an intangible firm. The means of production, the talent, the knowledge isn't bolted to a factory floor. The most valuable asset walks out the door every single evening.
And if they leave for good, the dead labor, the code base, it starts to rot because there's no living labor to maintain it.
It's a friendly hostage situation. The firm has to prevent the creators from leaving and, starting a competitor.
So FBC is the price they pay.
It's the necessary price capital pays to convert its most dangerous workers, the creators, into allies. They're transformed into a kind of, to use a term, petty bourgeoisie.
So they stop just asking for a higher wage.
And they start advocating for shareholder value because now they own a piece of that surplus value. It completely changes the game.
And this forces us to make a really crucial distinction that I think most investors miss when they just blindly subtract all SBC from cash flow.
We have to separate productive SBC from unproductive SBC.
Okay.
Productive SBC is when the R&D engineers, the builders, get stock grants. They are clawing back a share of the surplus value they actually created.
That dilution is a necessary tax shareholders have to pay to keep the core asset human ingenuity healthy and aligned.
Exactly. And then you have unproductive SBC. That's when highly paid management, who aren't directly building the IP, get massive grants. Under this framework, that's just pure rent extraction. It's the overseers sharing the spoils without adding to the stockpile of congealed labor.
And this makes SBC a powerful signal for investors.
A very strong heuristic. When a company pays its tech talent entirely in cash, it suggests that labor is just being consumed now, an operating expense.
But when they pay substantially in equity,
It's a tacit admission that the labor is being stored for the future. They are paying for capital expenditure in disguise.
so high SBC that's concentrated in R&D is a huge tell for an investor. It's screaming, our P&L isn't showing you our real assets, but our comp structure proves we're building dead labor.
And that reasonable dilution is just the price of alignment. In a business built on human capital, the only way to really own the asset is to share ownership with its creators.
So we've really landed on a profound insight here. We live in a market where the primary engine of value human ingenuity is just systematically ignored by standard accounting.
But by adopting this concept of congealed labor, we can correct the record. We can more accurately measure the risk and the return.
Okay, this framework gives you a really powerful, almost philosophical edge. So let's distill the key lessons for you, the listener.
First, just remember that every asset, whether it's a machine or an algorithm, is fundamentally just frozen human effort.
Second, your analysis of ROIC isn't just about efficiency. It's the measure of how well that frozen effort is being leveraged.
And third, stock-based compensation isn't just a cost. It's the necessary price of keeping that labor aligned, and it's a huge signal for assets that are hiding on the balance sheet.
You don't need to subscribe to the whole political ideology here. For a modern investor, these are just powerful intellectual tools.
Your edge comes from seeing the ghost capital that everyone else dismisses as just another expense. While the market sees costs being flushed away, you're looking for companies where that hidden dead labor is on the books at its low historical cost, but is yielding exponential returns that look like magic.
You know, as Marx famously wrote, the philosophers have only interpreted the world in various ways. The point, however, is to change it.
Or, in our case, maybe just to profit from seeing it correctly, find the congealed labor and you find the true alpha.